Okay, welcome to today's workshop. Of course, the minute before I go to click live, the internet's down. But just another thing in 2020 we got to deal with and push through, just like everything else we've been facing. So, welcome to today's workshop. My name is Jason Hamilton. I'm a certified financial planner and the founder of Keep It Simple Financial Planning, and the admin of this group and page. And generally, every Sunday about 2 p.m. Pacific time, 5 p.m. Eastern time, we're going to bring you a live workshop to help you improve your finances, take one step forward in getting better prepared for retirement. And today I have a really good workshop. It's pretty all-encompassing for a lot of things you should be thinking about as we're going towards the end of the year. So I think all of us are pretty happy that 2020 is coming to an end, and we're really hoping 2021 brings us a new perspective and maybe a little bit more on some positive notes here and some good things happening in our world. So hopefully you're doing well, you're staying healthy, and you're having a great beginning or middle, I should say, of your holiday season. So I want to wish everybody happy holidays. For those of you that are celebrating Hanukkah, happy Hanukkah. And for those of you that are going to be celebrating Christmas in a couple weeks, Merry Christmas early. After this Sunday, I'll probably be taking a couple weeks off and then come back in January for some really good new trainings I have in place, some new workshops to get us started off on the year on the right foot. So welcome again today. I do apologize for the delay. Like I said, it was just an internet issue. When I went to go click live, things were just out. So got some good stuff today for you. And if you have any questions, go ahead and throw those down in the comments. And for those of you that are watching live, we do a Q&A at the end. If this is your first time, go ahead and put your questions in, and we'll be happy to discuss those around the end. And other than that, that's pretty much what I got for you. We're going to get going here very shortly. All right, excuse me. So I want to know the things that are on your mind. As we're coming to a close on 2020, what financial items are on your mind? Go ahead and put those in the comments, and we'll do our best to address those today. Excuse me. Before we jump in, for those of you that are new here, I want to invite you to join either our Facebook page. You can find that. You can just search my name, Jason J. Hamilton, and follow us on our Facebook page or in one of our Facebook groups. The one is Your Retirement Coach, and the other one is Retirement Planning for Beginners. The Your Retirement Coach Facebook group is a little more advanced. We talk about a little bit more advanced subjects there. And for the Retirement for Beginners, obviously, like it says, that's much more of a beginner's type of group. So whatever you find yourself, you're welcome to join both. But depending on where you're at when it comes to your level of financial knowledge, you might want to choose one of those groups based on where you perceive yourself to be. So on that note, we're just going to jump right into today's workshop and get this going here. So today I want to talk about what financial issues you should be considering before the end of the year. Okay. So for those of you that have never worked with a financial planner, a lot of this stuff might be new. And for those of you, again, that have never worked with a financial planner, I would encourage you to get some help and get some assistance. And I know there's a lot of people that like to do things on their own. They think they could just figure everything out by Googling online. And I'm not going to tell you it's not there. It might be there somewhere. But the challenge is putting it all together, and really optimizing your overall financial situation. And I really think a good financial advisor, especially a certified financial planner, can really help you out with that. And so I would encourage you to get some help. And obviously we have services available, but at least get some help from somebody that can help you put this together. If there's anything I talk about today that might be new to you or you are unsure, don't just sit there hoping that it all works out. Do the right thing and get yourself some assistance so that you end up in the best possible financial situation for your retirement, okay? So before we jump in, as always, I have to put up my disclaimer here. That everything we talk about today is meant to be educational, okay? It's not meant to be specific tax, financial, or legal advice for anybody specifically, but this is more of a general knowledge type of forum where I'm going to provide you good things to be thinking about. And today, a good set of questions for you to be asking yourself and getting into place. So you might want to come back and rewatch this workshop once it's done, when you'll be able to pause it and be able to kind of take these things down and write them down and get them answered for yourself, whether it's on your own or with a financial advisor. But again, these is meant to be for education, not specific personal advice, okay? So the first thing we're going to talk about today is asset and debt issues. So the first thing you might want to ask yourself is, do you have any unrealized investment losses? So what that means is, if you have not realized your investment losses, you haven't taken them as a deduction off of your taxes potentially. So if you didn't know, each year you can write up to $3,000 from ordinary income on your tax return. So if you had a particular stock that didn't do well this year, or maybe even a fund that didn't do well this year and you have a loss, you can potentially take that off of your income for this year up to $3,000. Okay. The next question is, do you have any investments in taxable accounts that are subject to end of year capital gain distributions? So if so, you really want to consider strategies to minimize that tax liability. So that'd be something you want to work with your advisor or CPA on, but that's the next thing you want to make sure you're taking care of. And this is a big one for this year, actually. Did you reach your required beginning date? So what that means is, have you reached your required date for you to start taking your required minimum distributions from either your 401ks or IRAs? So if you didn't know, we had the CARES Act that passed earlier this year. And now our required beginning date for anybody turning 72 in 2020 or later is now 72. If you turned 70 and a half in 2019, well, you're still back on that 70 and a half required minimum distribution age. But for 2020, due to the CARES Act, your RMDs, or required minimum distributions, were actually waived for this year. So if that's something that you have already taken out and you're not aware, you want to make sure you get that back in if you don't need that money. Obviously, if you need the money to live off of, then you need it to live off of. That's not a problem, but there's many folks out there that have required minimum distributions that are quite a bit larger than they actually need to live. And so this year there was an ability to go ahead and put that back in or not take it out of your account, and that was waived for this year. So that might save you a little bit of tax money there. All right, the next thing we're going to talk about here is some tax planning issues. Okay, so tax planning is something that is going to be going on generally throughout the year, but also for sure at the end of the year. And tax planning is one of those subjects it's kind of like an ever-changing challenge that you're just trying to chase in a sense, because there's so many things that happen every year. And maybe not every single year there's big changes, but the last statistic I read was that since 1913, there's been a major tax change on average every 2.75 years since 1913. So this year was one of those years. There was a lot of changes. The CARES Act, like we just mentioned, tax bracket changed just a couple years ago with the TCJA. So these are things you need to be keeping up on as you are either before retirement, as you're just determining where to put your money and what types of accounts, or possibly in retirement when it comes to where you take your distributions from to fund your lifestyle. So these are some things you might want to think about. The first thing is, do you expect your income to increase in the future? So if you expect your income to increase in the future, then you might want to take advantage of some strategies to minimize your future tax liability. Okay, so something to think about is making Roth IRA or Roth 401k contributions this year, and possibly even some Roth conversions. For those of you that don't know, Roth conversions, you have to convert before December 31st. That conversion has to be complete. So if you're in the place right now where you're considering should you do a Roth conversion or not, now's the time to really be thinking about that, because once December 31st passes, you can no longer go back and do that for 2020. Okay, you want to take advantage of that now. Some other things to think about, if it's offered by your employer plan, you might want to consider making after-tax 401k contributions. So sometimes 401ks don't have a Roth option, but they have an after-tax option. What happens with that money essentially is when you move it from your 401k, you can move it directly to a Roth IRA at that point, but there may be some tax considerations in between to think about when it comes to your gains. But that might be something you want to take advantage of if you have space left in there and you're expecting your taxes to go up in the future. And the third thing in this subject here you want to think about is if you're over age 59 and a half. Okay, so you might want to consider accelerating your traditional IRA withdrawals to fill up lower tax brackets. So let's say, for example, if you're expecting next year to be taking your Social Security, for example, or maybe next year you're thinking about taking your pension, and this year you didn't take it. So maybe this year your taxes are going to be lower, and you might be in a lower tax bracket than you're going to be in any following year. You might want to consider taking a little bit more out of your IRA to fill up that lower tax bracket this year and get a little bit more money out at that lower tax bracket, because let's say, for example, you're in the 10 or 12% bracket this year, but next year, and basically forever, if you have a big pension coming in, you're going to be in the 22% bracket or above. Well, you might want to really take advantage of that extra space in your 10 or 12% tax bracket because it's going to be gone essentially forever if that's going to be the case for you. So these are things you might want to think about if you expect your income to increase in the future. Next question here is, do you expect your income to decrease in the future? If you're expecting income to decrease in the future, then you might want to consider strategies to minimize your tax liability now, as is, maybe using traditional IRA or 401k contributions instead of Roth accounts. So this is kind of the game you have to play. As you're looking at your contribution strategy each year, you want to look at your current and future tax liability that you're expecting. And if your income is expected to increase in the future, then a Roth is a great way to go. If you're expecting your income to decrease in the future, for example, you're going to be retiring in the next couple of years and your income is going to go to zero, then you may want to take advantage of pre-tax contributions through a traditional IRA or 401k. Okay. All right, and our third question here under tax planning issues is, do you have any capital losses for this year or carry forwards from prior years? So if this is the case, and what this means is, did you lose money on any of your investments, for example? Or have you lost money in the past that you still have losses that you can use to go forward? Generally speaking, losses that you actually recognize can be carried forward for essentially an unlimited number of years. So let's say, for example, 2018 was a year where many folks had negative returns on their accounts. Most accounts were somewhere between 6 to 10% on the downside. And if you would have had investments that you actually took the loss that year, maybe you sold off some accounts, you did some rebalancing, some tax loss harvesting, well, you can carry forward any of those losses you couldn't claim each year. Because as I mentioned before, you have up to $3,000 that you can claim each year as a capital loss. Okay. The next thing we're going to talk about here is, are you on the threshold of a tax bracket? So similar to what I mentioned before, you really want to be thinking about, are you on a threshold of a particular tax bracket? So some things could come up are if you're on Medicare, looking at IRMA, okay? So IRMA is essentially if you go over certain income amounts, you could be penalized on your Medicare. And there's generally a 2-year look back on this. So if you're going to be going on Medicare within the next couple of years and you have a high income, this is something you might want to be thinking about now, is how to reduce your income so that you can not have to pay that additional penalty that may be coming if you're going to be on Medicare sometime soon. Some other things to consider is if you're in a lower tax bracket, as we mentioned before. There's really some advantages today to some of our lower tax brackets, and honestly, we don't know what we're going to experience with if we have a new president coming in who's already said he wants to increase taxes. So these are things you want to be thinking about. We do have some very, very low tax rates, and I think they're some of the lowest we've ever had. So you might want to take advantage of any of these lower tax brackets you're in today, because if you remember our previous tax brackets, before it was 22, it was a 25% tax bracket, and our current 24 was a 28% tax bracket. So even if this year you go into the 24% tax bracket, you're still better off if we lose that 22 and it goes back to 25. So these are all things that you really want to take a look at. And ideally, you'll start with just adding up all your income sources and see where you're at after your standard deduction. And that will give you an idea of how much room you'll have in each tax bracket. Okay. The next thing to consider is if you are charitably inclined and you want to reduce taxes. So if so, for 2020, the CARES Act has created a $300 above the line deduction for contributions to certain qualified charities. So those are generally the 501c3 charities. And the interesting thing about it being above the line is, since we've had the TCJA, the Tax Cut and Jobs Act, where we raised the standard deduction, many folks who are charitably inclined essentially lost their ability to deduct some of their charitable contributions because their standard deduction went up so high that they no longer get credit for that. Ideally, we're making charitable deductions because it's out of the goodness of our heart, not just for a tax deduction, but we will always take that tax deduction because, hey, why give the IRS more money if we don't need to do that, right? But something that was created in 2020 was a $300 above the line deduction. So even if you are only claiming the standard deduction, you can still take a $300 above the line deduction to claim off your taxes. So if you are looking at some last minute charity giving, now would be the time to do that, and you can claim up to $300 to do that. Okay, and let's see here. The other thing to consider is what we call bunching. Okay, so bunching your charitable contributions. So a lot of people like to just contribute a certain amount every year. So let's say you contribute $10,000, for example, each year. Well, maybe after your standard deduction, you're not able to deduct any of that charitable deduction or any of that charitable contribution. What you might want to consider is what we call bunching your contributions. So instead of doing $10,000 in one year, each year I should say, maybe you do $20,000 in 1 year and then zero the next year. And if that $20,000 allows you to take advantage of a charitable deduction, then you end up better off. You keep more of that money after taxes, which allows you to possibly give more to charity. So those are some things you might want to think about when it comes to your charitable deductions. And you might also want to consider what's called a donor advised fund. So essentially a donor advised fund allows you to put money that you're going to contribute to a charity in a special account and then use that as needed to essentially contribute to wherever you'd like to contribute. Okay, as long as it's a qualified charity, you can use that money and claim that tax deduction. And the last thing in this category is verifying if you're going to be receiving any significant windfalls that can impact your tax liability. So some things in this area are inheritance, RSUs, which stands for restricted stock units, and potentially some stock options that you may be maturing from work, or even that year-end bonus. So these are all things that could affect your tax liability, and you want to make sure you're accounting for these when it comes to planning your end-of-year tax planning. And one final thing here is to consider if there's been any changes to your marital status. If you've either gotten married or divorced, or possibly, God forbid, widowed. Hopefully that's not the case. But there are situations that will apply that might change your tax status. So you want to verify that if you've had a change in marital status, that you're filing your taxes right and you're planning appropriately when it comes to your deductions and your possible tax planning issues that may arise. All right. Okay, so let's do a question real quick here. Let's see. So Ed asks, what is the income limit for Medicare for married filing jointly? It's about $170,000, Ed. I think it's $85,000 for singles and $170,000 for MFJ. Okay, so if you're going to be over that, and that is MAGI, so that counts everything all together. So that's something you want to be aware of, but that's a great question. If there's any further questions, folks, go ahead and drop them in the chat, and we'll do our best to, I'll do my best, I should say, to answer those along the way. Okay. So now we're going to talk about cash flow issues here. So, question, you have a couple weeks left. Are you able to save more? Are you sitting on a big pile of cash that you're not sure what to do with, and have you not maxed out all of your potential accounts at this point? Something to think about is if you have an HSA, you may be able to contribute up to $3,550 if you're single, or up to $7,100 for a family, and potentially an additional $1,000 to each of those if you're 55 or older. So HSAs, folks, are one of the most valuable accounts that you could possibly have. They are what's considered triple tax-free. When you put money in, you get a tax deduction. The money gets to grow tax deferred or I should say triple tax advantage. The money gets to grow tax deferred while it's in there. And many HSAs allow you to invest in that account just like an IRA. And then when you take the money out later down the road, if it's for any sort of medical expenses, the qualified medical expenses, then that money is tax-free as it comes out. So HSAs are what's called a triple tax advantaged account. It's a beautiful account, really, really useful. And beyond your match at your work, if you have an HSA, you might want to consider contributing to one along with a Roth IRA as well. All right, the next thing here is if you have an employer retirement plan such as a 401k, are you able to save more? You might want to really look at that and verify you're actually taking advantage of all the contributions you can personally make. The maximum salary deferral for 2020 is $19,500 if you are under 50 years old. And if you're age 50 or older, you can add an additional $6,500 on top of that for a total of up to $26,000 that you can contribute to your workplace 401k plan. Similar for your 403b or TSP account, depending what type of workplace plan you have. One thing to consider as well before the end of the year, if you want to contribute to a 529 account, which is known as a college savings account, you can put up to $15,000 per year to a beneficiary's 529 account, and you can do that gift tax free. Alternatively, you can do what's called super funding, a 529 account, and you can put up to $75,000 in 1 year to each beneficiary, and elect to treat it as if it were made evenly over a 5-year period, again, gift tax free. So for those of you that aren't aware, you're allowed to give up to $15,000 to anybody you want, essentially, without any gift tax, and that's per person, right, per spouse. There's a special circumstance for 529 accounts that's called super funding, where you can put up to 5 years in at one time, so up to $75,000, which, if you understand compound interest, this could potentially be very beneficial for somebody you might be wanting to contribute to for college. Okay, so this is a great thing to do before the end of the year, and I would highly recommend you check into that if that's something you are interested in. Okay. All right. And the next thing we're going to address here is if you have a balance in your FSA before the end of the year. Okay. So what is an FSA? An FSA is called a flex savings account. It is similar to an HSA, which is a health savings account, where they both can be used for healthcare. But the big difference between the FSA and the HSA is within your FSA, you cannot take your contributions with you beyond $500 generally. There are some special circumstances, but beyond $500, you're not going to be able to carry that over to the next year. So there are circumstances this year that I'm seeing that many folks might have had health things they wanted to do. They might have wanted to go to the dentist or the doctor to get things done. But due to COVID, they were not able to get in and get those appointments and get those procedures done. So they're going to be losing potentially thousands of dollars in their FSA accounts. So if you're going to have a balance, by the end of the year, you might want to consider, doing something with that. But there are some companies that allow a grace period of up to March 15th to spend the FSA funds. So if you have an FSA, you want to check with your company that if you still have money left over above the $500 limit, I think it's $550 now actually, that you might have that grace period up to an additional 90 days to submit receipts for your previous year. Okay, so you want to check into that at work and make sure that is the case. And the most companies offer you 90 days from to submit the receipts from the previous year as well. So even if you had the expenses, some companies offer up to 90 days to submit. But if you are going to have funds left over that you did not use, you really want to create a plan for that. And if you have that grace period, do what you got to do in the early months of the year to go to the doctor, go to the dentist, get those procedures done so that you don't lose that money, because that's really, really hurtful. And this is why I like HSAs more than I like FSAs, but they're not always an option for everybody at work. Mary asked a good question here. Is it FSA giving extension due to COVID? No, not that I know of. Nothing particular. Just would be based on your plan. Okay, so whatever your plan says, so you want to check into that with your workplace, maybe your HR department, and they will inform you on what's available for you there. Okay, good question though. All right, and the next thing I want to talk about here is, did you meet your health insurance plan annual deductible? Okay, so if so, consider incurring any additional medical expenses before the end of the year, at which point your annual deductible will reset. So this is a big one. I know we only have a couple years, and we probably should have talked about this a little bit earlier. But if you can get in, and let's say you've already met your deductible for the year, so you don't have to pay any more out of pocket, well, you might want to take advantage of anything you can do to get some medical procedures done, dental procedures done, so that you can take advantage of that grace, you could call it the free money, above and beyond what you've already paid in for your current deductible, okay? So again, I know it's a little bit late on that one, but something to think about. And if you can do it, then I would highly recommend that you do that. All right, next we're going to talk about estate planning issues, okay? So have there been any changes to your family, heirs, or have you bought or sold any assets this year, okay? So if you have, you may want to consider reviewing your estate plan and making sure that you possibly update that if need be, so you're staying on track. There's a lot of changes this year with the CARES Act when it comes to estate plans. So if the last time you looked at your will or your living trust was 5, 7 years ago, 10 years ago, you really might want to get an appointment scheduled with your estate attorney to review and possibly update depending on your current situation and any changes you might have faced this year. All right, and the next question here is, are there any gifts that still need to be made this year? And if so, you want to take advantage of the annual exclusion amount, which is up to $15,000 per year per donee, okay? So that means, each person can get $50,000, but if you are married, each member of the household can also give $15,000 each to an individual donee. So if that's your case, what I'd recommend there is writing 2 separate checks. I think you can write 1 check and just split it up that way. But I like the idea of keeping things clean and writing that second check to make sure it's very clear on where the money came from when it comes to giving to to anybody you're going to be giving to. And I think the technical rule is if you have a joint account, you can do a $30,000 check for 1 check. But if you have separate accounts, then you probably want to do separate checks. You don't want to do 2 checks from a singly owned account for the same person. It's just going to give you a headache when you're going to get this filed and if you were to ever have to account for this to the IRS. Okay. And the one last thing we're going to talk about today is, do you have any children in high school or younger who plan to attend college? And if so, you want to possibly looking at some financial aid planning strategies, such as reducing income in specific years to increase financial aid packages, right? So there's specialists that really dive into this stuff, and if you need a referral in this area, I'm happy to refer you to somebody that specializes in this. But these are things you want to be thinking of before the end of the year. So folks, I hope you enjoyed this workshop, and I would recommend that you go back through and maybe pause this video along the way, note these questions down so that you can get these answered for yourself before the end of the year. We got just over 2 weeks left before the end of the year. And if you'd like to really think about 2021 as a year you get your finances in order, as a year it's time for you to put your line in the sand, to get some help, to get your financial situation mapped out, to get your retirement strategy mapped out, your tax planning, your investments, your insurance, your estate, cash flow, all the things you need to do to get in place to make sure you have a good financial strategy. Well, then we'd love to speak with you. I'm not sure how many appointments I have left at the end of this year, but definitely in January there'll be some things opened up there. And if you'd like to schedule a complimentary retirement strategy call, you can go to keepitsimplefinancial.com/talk. Once again, that's keepitsimplefinancial.com/talk. And you'll find my calendar page there. And I would love to speak with you on a complimentary call. On our call, we spent about 45 minutes to an hour really mapping out the big points for your retirement strategy that you need to be taking care of. And if it looks like there's things that could use my help, I'll let you know that. And if not, then I'll send you to the next best resource and give you the top things that you should be doing to help you get to the better situation for retirement in the future. Okay, so that's what we have for you today, folks. I hope you enjoyed this. Hope you found this valuable. And if I don't see you before the end of the year, I'm going to wish you a wonderful holiday season and a wonderful 2020. And I hope all good things happen. I hope if you've been healthy, I hope you stay healthy. Hope we get this vaccine now so we can get back to normal life. We can get out, get some sunshine, and spend time with our families. And for those of you that are sacrificing this year for health reasons, not spend time with family, do your best to do something just to keep you engaged. Maybe set up a Zoom call or a FaceTime chat, because even though you're not there, having videos, seeing facial expressions, and just saying hello to people really can make a positive difference in your mindset and how you're thinking about things. So we really appreciate you paying attention, joining us today, and we'll see you on the next one, okay? Have a great and wonderful weekend, holiday season, and we'll see you next time. Bye-bye now.